Welcome to our Meet the Managers sessions. For this week we're joined by Bob Sherini from Ausstock, who are an investment bond specialist. So welcome, Bob.
Thank you.
So first of all, what are investment bonds?
Well, investment bonds are a tax holding structure. The best way I can describe it is a little bit like superannuation. Superannuation is a trust structure that sits above investments. It has certain tax ramifications, and an investment bond is exactly the same. The difference between superannuation and investment bonds is that the investment bond provider pays tax internally at 30%, where, as you know, inside superannuation it's 15%. This obviously has certain benefits. It's not as good as superannuation, but of course superannuation is subject to preservation.
Yep.
And with investment bonds you have access to your capital. So you don't quite get the same tax benefits, but you have access to your capital at any time.
So you briefly looked at the tax concessional structure of investment bonds. Just tell us a bit more about the benefits of that structure.
Okay, with the structure, for an investor, you do not have to furnish a tax file number to us. The bond pays tax each year internally and is reflected in the returns that you receive, which means that there is nothing for an investor to put into a tax return in any given year. And if you hold the bond for 10 years, which you don't have to, I mean you can withdraw whenever you want, but if you hold it for 10 years you can withdraw any or all after 10 years and there is nothing to report. So in actual fact you could go the whole life of the investment without ever reporting anything on your tax return.
Yeah, so there's no accessible income after that 10 years because the company's already paid, yourselves already paid for the tax. Yep.
Correct.
Yep. And what are the kinds of things that an investor should be aware of before or when considering investing within an investment bond structure?
Okay, so I think an investor going into a bond should be prepared to stay for 10 years to get the maximum benefits. The things that they need to be aware of is if they do need to access the money before the 10 years, then they can do so, as we've already said a couple of times. The ramifications of that is that any profit that they make would be assessed as taxable income, but there is a tax offset to reflect the tax that has been paid by us. So in effect, inside of 10 years, the investor could redeem the money, and effectively make up the difference between their marginal tax rate and the 30% that's already been paid. So even the worst case scenario, drawing early is not that bad at all.
Yeah, and ideally it's really for those high net income earners who are looking to save for the medium term, for children's education and things like that. That's sort of
well, it could be
the
for
demographic.
Any specific purpose. If we related to superannuation, superannuation is for retirement. We say bonds are for accumulating lump sums for anything else that's out of retirement. So you've talked about education. There could be things like 3-month holiday to Europe in 10 years' time. It could be things like buying another house, weddings. I've got 2 daughters, so I've got an investment bond, and I think that may end up going towards weddings.
Yep.
The only other thing that we'd need to watch out for is if a potential investor was on a marginal tax rate of below 30%, so someone that perhaps wasn't working or was only earning $15,000, $20,000 of income, then it may not be the best place for them, because in effect the bond would be paying more tax than they themselves would in individual names.
Yep. And then finally, what can we actually invest within the investment bond structure? So what investments can a client purchase and invest in?
Okay, pretty much any asset class that they want. Of course, there are constraints, and in the case of investment bond providers, the constraints are limited to the menu of investments that are provided. So in the case of Ausstock, we provide access to 30 managed funds from some of the highest regarded fund managers from around the country and around the world, covering all asset classes, so cash, term deposits, fixed interest, shares, both domestic and international, property, or a combination of all of the above via balance funds and things like that.
Yep. So I hope that gives you insight into investment bonds. It's just another strategy that we use here for to enable clients to build their wealth. We look at super, we look at gearing, and investment bonds is another strategy that we can use for clients, and we have used for clients in the past. So thanks, Bob, for joining us today.
Thank you.